Assalamualaikum and hello everyone. Welcome to my third presentation on Mfrs 138 Intangible Asset. And in this session, we are going to deal with the initial measurement of for the exchange of asset, and we're going to look at an example, a work example for the exchange of asset. If you can still recall, for the initial measurement of the exchange of asset, initial costs for the intangible asset is going to be measured at the fair value for the exchange of intangible asset if it can be reliably measured. If not, the cost will be the carrying value or carrying amount of the asset given up. Let's look at this illustration. Rice Berhad, which is the reporting entity, Rice, acquired a patent for a new method. So the patent will being acquired, and that was for water purification. The patent has a carrying amount. So the carrying amount is 2 million. The carrying amount. And the fair value of that patent was 3 million. And Shine, which is another company, is about Rice and Shine. So Rice is having a patent, and Shine has some export title, quota. And what they are doing is they are going to exchange this, and the quota, which is, this is of Shine, this is of Rice. The quota has a fair value, and this is for the patent, right? The fair value is 4 million. And 1st July 2003, Rice Berhad wants to exchange the patent. So there is an exchange here of an intangible asset. Let me just get my highlighter. I'm going to take a red color here. Where is the red? Let me just check it. Okay, here. So the exchange, to exchange is patent with the textile quota by paying additional cash. So some cash will have to be credited, yeah. So there will be some credit to the cash. By whom? By Rice. So you are required in the books of Rice Berhad explain the accounting treatment of the exchange of these two intangible assets, patent and textile quota. So let's look at how do we treat this. The value of the quota here is 4 million, and this is the fair value of the asset that you would like to have, Rice would like to have, which is the fair value of the asset received. So this is the fair value of the asset received, and the fair value of the asset given up, if you can see the asset given up here, is having a fair value of 3 million. 3 million, and this is the fair value, the carrying value of the asset given up, the patent, and the difference is going to be recognized in the statement of profit or loss, the difference of 1 million. So let us look at the accounting treatment. So the quota will have to be debited because this is the asset that is exchanged for. The patent will have to be credited because you need to de-recognize or during this exchange, it is now no longer belongs to Rice. The cash will have to be credited because Rice pay some cash, and the income will have to be also credited, gain on the difference between the carrying value on the change in the value, fair value, right? So that was being credited. So therefore, the new asset, new intangible asset of Rice is quota. There is no more patent. So now we move on to internally generated intangible asset. This is not dealing with R&D, but this is dealing with internally generated intangible asset in the case of goodwill, brands, masthead, and items similar in substance, as we have discussed earlier. You can refer to my second video for that. Okay, sometimes it can be difficult for a company to assess whether internally generated asset meets the recognition as an asset. So that difficulty is because it is not identifiable and the cost cannot be determined reliably. So meaning that the recognition criteria is not met. So if that is the case, Mfrs 138 restrict the recognition, prohibits the recognition of the following internally generated intangible item: goodwill, internally generated brand, masthead, publishing title, and other items that is similar in substance. So this will not be recognized. Why? Because it is not identifiable. It is not a separable item. It is also not arising from contractual or legal rights. So therefore, it cannot be reliably measured at cost. So these are all not being fulfilled. So you cannot recognize that as an intangible asset. Then that is not possible because that cannot be distinguished separately from the cost of developing and operating the business as a whole. So therefore, that is just a cost of operating the business, and that is not an asset. So you refer to paragraph 48 and 49 for the internally generated goodwill that is not recognized as an asset, intangible asset. And also paragraph 63 and 64 for the items similar in substance to goodwill, but these are brands, masthead, and customer list that were mentioned specifically in the standard. Now we move on to recognition of expense, because those items just now, if an intangible item does not meet the definition and recognition criteria, what we need to do is whatever expenditure related to acquiring it or to generate that intangible asset, it is not going to be capitalized, but it will be recognized as an expense when it is incurred. Next one is to look at what are the example of those items. These are the one being listed in the Mfrs 138. Items like primary expenses, pre-opening costs, launching of a product, launching of a process, of a service. These are all operating costs. Apart from that, expenditure on training, advertising, and promotional, these are not something to do with brand. This is just an operating cost, or more specifically, that's a selling cost. Relocating or reorganizing part of an enterprise. Expenditure on research is also recognized as an expense. We'll have a specific section in our next video which will be discussing on R&D as an other intangible asset, internally generated. So these are not going to be recognized as intangible asset, this type of expenditure, because they cannot be distinguished from cost of developing the business as a whole. Okay, so they cannot be distinguished. So they are not intangible asset. Next. Same goes for past expenses. These are not going to be initially recognized as an expense this year, if previously it has been recognized as an expense. So in this current year, for example, it should not be recognized as part of cost of an intangible asset. So it cannot be recognized as an asset if you have been in the past recognizing that as an expense. So let's look at some example here. So this one is about launching costs. If you read the example, you can spend your time go through the example, but this one is launching expenses which were costing them 1.2 million. They generated a lot of favorable publicity, and now they also need to incur training costs because of that new retail outlet. And is this an asset or an expense? It is an expense. Okay, can you follow me? Now, B, second one, you have employed an external consultant. So you hire a consultant at a cost of 200,000, and the task is to reorganize the internal policies and procedure. And the organization will take 3 months. And if that happens, it is expected to reduce the cost significantly. But this is not the existence of future economic benefit. So this is also not an asset, but it is an expense. Another one, the company develop brand. So if you think you develop brand, that is not an intangible asset, because those are normally expenditure that relates to promotion or advertising, right? So here they maintain the brand. They say it is a brand, and developing the brand further, they want to have spent some large amount. These are things that happen, and these are also not an asset. It is going to be, it does not satisfy the recognition criteria, right? And they cannot be distinguished from the cost or incurred in respect of developing the business as a whole, and therefore the costs are being recognized as expense as incurred. Now we move on to another important step, which is subsequent measurement, or measurement after initial recognition. Measurement after initial recognition, or in the standard, this is called subsequent measurement. Mfrs 138 allows choice of accounting treatment. There are two choices here. One is the cost model, that is the same as in Mfrs 116 PPE, and the same thing here is also revaluation model. So basically it's the same, where after initial recognition, the cost, the asset will be shown at cost less accumulated amortization. So for PPE, you are using the term depreciation because that is for tangible item, tangible asset. But this one is for intangible asset, so it is using the term amortization. So minus the accumulated amortization and minus the accumulated impairment loss. Impairment loss. So therefore this will give you the carrying amount. So and the revaluation model is the same. You are going to carry the asset at the revalue amount, and the revalue amount will be the fair value at the revaluation date less the subsequent accumulated amortization and any subsequent accumulated impairment loss. So this is similar to Mfrs 116. I won't go into detail. For the revaluation model under Mfrs 138, you can only apply this revaluation model if the intangible assets fair value can be determined using active market value, if there is an active market value. So the carrying amount of the asset is, if you can recall, under Mfrs 116, it is at fair value. Revalue amount is the fair value at the revaluation date less deducted with the subsequent accumulated amortization deducted with the subsequent accumulated impairment loss. Exactly the same as per Mfrs 116, with the exception of the term amortization that is now taking over the term depreciation. Okay, under paragraph 81, this is the guideline given. If there is no active market, the intangible asset shall be carried at cost. Under paragraph 82, if these are guiding you on the last revaluation. And then paragraph 85, similar to Mfrs 116, treatment of surplus on revaluation is for you to recognize in ARR, asset revaluation reserve, and the other comprehensive income as part of the equity. If this is for the initial revaluation, this is on the initial revaluation. For the treatment of deficit, this is also similar. For initial revaluation, it will be treated in the profit or loss. And you also need to have a transfer of revaluation surplus to retained earnings for the revalued asset, paragraph 87. And on the revaluation as per paragraph 80b, any accumulated amortization must be eliminated against the gross carrying amount. So in the Mfrs 116, you are talking about any accumulated depreciation. But here, as I said, depreciation is not the term is amortization. Paragraph 83 talks about impairment. If there is an indication of impairment is discussed under Mfrs 136, but the application is under Mfrs 116, and that is also similar here in Mfrs 138. Okay, so normally there is an impairment when there is a disappearance of active market, or when active market no longer exists. So you need to go and test for impairment annually or as frequently whenever there is an indication that the asset is impaired. And this is more important for a revalued intangible asset if it uses the revaluation model, like in our case here. So revaluation should be made frequently, like at least once a year as necessary, to ensure that the carrying amount and fair value are not materially different. If they are materially different, maybe there is an impairment that need to be charged as at the reporting date. So revaluation model, the rules are the same as the application under Mfrs 116. The changes shall be accounted as follows. So if there are increase in the carrying amount as a result of revaluation, which means that fair value are greater than the carrying amount, this is what you call revaluation surplus. Otherwise, if it is the reverse case, the fair value are less than the carrying amount, this is a revaluation deficit. If for the first initial revaluation, this is initial revaluation. Initial revaluation, the increase or the surplus shall be recognized in other comprehensive income, or OCI, and it is credited to the revaluation reserve, ARR, and it will be accumulated under the statement of changes in equity. If you have the second revaluation, second or subsequent revaluation, the increase, if this is a surplus, it will first need to be recognized in the profit or loss if there is a revaluation deficit that has taken place before that. So you need to go and offset the surplus with the deficit, as long as it is the same asset previously recognized in the profit or loss. So that was exactly similar to Mfrs 116, with the exception, as I said, with the term revaluation here is the same, except that we are talking about the case of amortization, which makes a difference. So the decrease, which is under initial revaluation, shall be debited as revaluation deficit, same as Mfrs 116. If that happens subsequently, the decrease shall not be recognized directly to the deficit if there is a credit balance in the revaluation surplus in respect of that same asset. So you need to go and charge them in the OCI, and also charge to the revaluation surplus by reducing the surplus still to be zero. So let's say if you have a surplus and deficit at the deficit for the second time or subsequently, the decrease is recognized in other comprehensive income, and that will reduce the amount accumulated in the equity. So basically, before this, you may have a decrease. Let's say first time decrease and second time decrease. That is not the issue. The issue is that the second time, if there is a decrease, you need to go and observe if there is any revaluation surplus balance. You may, or you actually need to use that first before you go on debiting that to the profit or loss. You must use up the revaluation surplus balance. The next one is on the factors to be on the useful life. So these are some of the factors to be considered when determining useful life of an intangible asset. There are altogether 8 factors. You can check that later, paragraph 90. Useful life of intangible asset is divided into 2. Finite useful life, it is under paragraph 97 to 106, and indefinite useful life. Finite useful life means there is a limit to the foreseeable period, yeah. Whereas indefinite useful life, there is the period is indefinite. Intangible asset with finite useful life will be amortized. Right? Amortized means charge need to be made. It will be depreciated, but that depreciable amount is going to be allocated and called amortization, and it is an allocation of that depreciable amount over the systematic basis over useful life. And more specifically, this is only for finite useful life. So the amortization will start when the asset is available for use, and it will stop when the asset is being derecognized. So it will cease. And the amortization method or the pattern should reflect the asset's future economic benefits to be consumed. It can either be straight line method, reducing balance method, etc. And amortization need to be recognized in the SOPL, and with some exception, if you are you need to also look into detail recognition of expense here. So it is always recognized in the SOPL. Statement of profit or loss. The residual value is assumed to be 0. That was under Mfrs 138 paragraph 100. The amortization period need to be reviewed, and the method need to be also reviewed at least once a year, paragraph 104. For indefinite useful life, there is no amortization because there is no foreseeable limit to the period over which the asset is expected to generate net cash inflow, like the case of trademark, the case of certain brands that has been in the practice or in the business world until today, right? Paragraph 88, not amortized. For indefinite useful life, no amortization. No amortization. However, it will be tested for impairment when there is an indication that the asset is being impaired. Normally when the carrying amount, CA, is higher than the recoverable amount, RA. And the difference is what you call impairment loss. That is under paragraph 108. And the treatment of impairment loss will differ depending on whether it is using the cost model or the revaluation model upon its subsequent measurement. Review of useful life shall be made each period. Any change from indefinite to finite life is a change in accounting estimate. Okay, I'll be just stopping here. I will continue with my next video with the impairment test. Thank you for watching. Assalamualaikum. See you when I will see you.